Andrew Carnegie once said that a sunny disposition is worth more than fortune. And in that spirit, I aim to be an optimist. But when confronted with, let's say, unfortunate facts or reality, I think it's important to wake up and say, okay, what's actually going on here? And so when you see Vanguard, one of the pioneers in index funds, low-cost index funds, say, look, you know what? We're forecasting for the very same indexes that we're effectively selling as an index fund. We're forecasting pretty lousy returns in the next decade ahead. I think it's worth paying attention to. You don't see a lot of companies say, oh yeah, I'm going to sell this product and I'm not expecting much from it. Maybe you shouldn't be buying it. So if Vanguard's doing that, I think it's worth paying attention to. So let's dive into this video so that way investors in index funds around the world can understand, well, wait a second, why is Vanguard themselves, this powerhouse in index funds, saying, yeah, we're expecting really lousy returns this next decade? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, none of this is financial advice. And so, as we look at this, first, a quick recap. A lot of folks are familiar with Vanguard. They're one of the largest asset management firms founded by Jack Bogle with the core pioneering idea that low-cost index funds were the future of investing. Given that they've managed to grow to over $7 trillion in assets under management and helped investors avoid tens of billions of dollars of active management fees, it looks like he was right. Now, while a lot of folks recognize the Vanguard name, they don't realize that Vanguard also provides a monthly commentary that also includes asset class return outlooks, effectively saying, yeah, here's this segment of the market, and this is what we expect it to do over the coming decade. Unfortunately, the picture they're painting isn't very pretty. The schedule to the left shows Vanguard's 10-year nominal return projections based on various stock indices. Vanguard is forecasting effectively negative real returns for U.S. growth stocks. They're saying the nominal return will be around -1 to +1 when you factor inflation. That might be negative several percent from a real perspective. They're effectively forecasting slightly better than zero for U.S. stocks in general. Value is expected to do a little better. Global equities excluding U.S., so global equities excluding the U.S. are expected to be effectively in the range of 5 to 7% in a nominal range. Honestly, this is a really lousy outlook, so we'll want to understand in further detail, how are they calculating this? Is it reasonable? Should we believe it? But before that, we also need to understand that stocks are only one part of the equation. Fixed income is another core product and another key aspect for a lot of investors' journeys. And fixed income is even worse. This shouldn't come as a surprise to investors, as rates are already so low, and any rise in future rates will hurt future returns. As rates go up, prices go down. In my opinion, this setup is particularly dire for savers, retirement plans, endowments, and pension funds that are forced to own both stocks and bonds that aim for, let's say, a 7% plus return. This is pretty much an impossible hurdle if you're forced to do a 60-40 stock and bond investment allocation. Many of these investors are turning towards debt financing as a potential solution. This means either by increasing their allotment to alternative assets, which often means leveraged private equity, or using margin to directly increase their exposure. This topic has huge potential ramifications for society and arguably future potential money printing that I will save for later. This is, in my opinion, a huge topic, really important to just start thinking about at this point, especially if you think, wait a second, there's a possibility this next decade that we don't get, let's say, 7% returns in stocks. And what could that mean for all these, major institutions that have effectively promised their counterparties, let's say, 5% a year or 8% a year? One question you might be asking is if a 10-year equity forecast is even reliable. The answer is they're actually pretty reasonable in a range. Here's their same forecast. Once again, Vanguard's same forecast from a decade ago, projecting effectively 6 to 11% annualized returns, where actual returns came in closer to mid to high teens. So why the delta? Usually the deltas are tied to valuations, as earnings growth for an underlying index usually doesn't decelerate or accelerate significantly from the historic rates. So let me elaborate on this key point where you can look at how, let's say, a basket of 500 companies or 1,000 companies will grow over a decade or 2 decades. You'll say, oh, these companies are growing at maybe 5-6% annualized. And so what you'll end up doing is say, oh, okay, so this means the future returns, let's layer in that historic growth rate. You have a certain set of productivity, a certain set of growth, let's say 5-6%. If you get a one-time tax benefit because you cut taxes, then it skews up a little bit higher. But over time, you can look at a multi-decade growth rate and it doesn't change dramatically. You might have one-off events like a pandemic or a tax cut that does, cause things to get tweaked a bit. You can't generally forecast those things, but you can look at over a multi-decade perspective and say, okay, this is the general earnings growth rate or fundamentals growth rate for this basket of companies. And you could say, okay, within a range of confidence, 5-6%. So what's the other component that drives the return? The other component is valuation, which is something that a lot of folks say don't matter. Reality is it matters a lot, especially when you're thinking about long-term perspective returns. It's certainly something that Vanguard, pays attention to, where they say, okay, what's long-term potential valuation ranges? What's historic valuation range? So they'll look at back over several decades and say, okay, this is the starting valuation where we are today. Let's say the average, is around here. So then if it's trading at a premium, let's say it gets worked down over time. And if it's trading at a discount to the average, let's say over time that's an additional benefit to return. So you start off with that core growth that's based on effectively looking at average, which doesn't change dramatically over time, and then factor in some sort of premium or discount based on the current valuation. Now, that valuation might be some sort of like price to sales multiple or price to earnings multiple. Generally, looking at price to sales is pretty accurate looking at it there. In Vanguard's case, they're looking at different types of earnings and adjusted earnings for margins and cyclicality. But generally doing this type of analysis, looking at a historic rate and saying, hey, this is where we are today. If we're at a premium and there's a premium valuation and it needs to get worked down over time, that could potentially be a headwind. And that's part of the reason why Vanguard is saying, yeah, we're expecting lower returns, effectively saying, hey, yeah, the valuations seem to be a premium relative to history. Is it possible that it works back down to its average? And if that's the case, then you could be expecting lower returns. So if you have the mindset that, look, valuations are permanently going to be higher in the future, then you could probably just ignore their outlook and say, you know what, I don't care. I think this is just going to keep growing. That said, I do think it is important because a lot of folks that say, hey, valuations will forever be high, they're also being confronted with an uptick in inflation that could really upset that model. So, looking at this, saying, oh, okay, they previously forecast something. The reason why it did better than they expected is arguably because valuation expanded more than they expected. That's actually quite reasonable, in my opinion, looking at the past decade. So what can investors do about this, I'd argue, less than optimal setup? So I think there are 3 key components. Personally, I think it's prudent to look and invest in bargains wherever they are. Vanguard saying, look, a global non-U.S. portfolio might have higher returns. And that's part of the reason why I have a geographically diverse portfolio with investments that operate all around the world. Given the prospects of flat or even negative returns over this next decade, investors that want to do better will need to be picky. With indices potentially underperforming, you're likely going to be swimming against the tide. I mean, that's, I think, a realistic, not trying to be optimistic or pessimistic, but that might be a realistic perspective if you want to try to beat, let's say, the lackluster indices over the next decade. You'll want to turn over a lot of ideas, in my opinion, and every month consider a new idea and look for companies that are either very cheap or have a lot of growth potential that isn't fully priced in. Personally, I love the hunt for new ideas. I love exploring new business models. I love looking for exceptional companies. I love looking for unrivaled companies. That's part of the reason why I created this channel, is to share part of this journey of saying, hey, here are some of the companies that I come across. And that's also part of my value proposition with my Journey subscribers at unrivaledinvesting.com, where I try to call out a potential multi-bagger each month. Once again, just turning over rocks, trying to find something that could be exceptional, trying to be picky about this is something that's really special. And the reality is that not all investment climates are the same. The weather changes. The indices are near all-time highs, despite, a lot of news that you've heard. The reality is the indices are still within just a couple % of their all-time highs. And future, it's possible that in the future, future returns might be better. You could have a period where, let's say, stock prices go down. I'd say prepare for a rainy day where future returns might be more attractive. Effectively here it is, Vanguard saying, yeah, current future expected returns aren't great. Maybe in the future, you prepare for a period where Vanguard's saying, yeah, we're expecting, high single digit, low teens, or maybe even, mid-teens. So I'd say be prepared to react when the opportunities you've been searching for start to appear. This requires the mental fortitude to say, okay, I'm going to do, I'm only going to swing when I'm really confident that something has incredible upside potential. This means patience, where you're, sitting back and saying, okay, even if everyone else is getting rich on something, I'm going to wait till there's something that I truly understand. Maybe it's an asset that I'm actively producing versus, let's say, some new scheme that folks are getting excited about. It also means, having liquidity, so that way you effectively have the cash to react when the environment changes, where, the expected outlooks can be better based on, valuations effectively. And if this video talking about Vanguard's expected outlook for their own products effectively, the US indices and global indices, if this has been helpful for you, talking about expected future returns and arguably the less than optimal prospects for US stocks, if this has been helpful for you, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.